from ICICI Securities. We have with us today Mr. V. Vaidyanathan, Managing Director and the CEO, Mr. Sudhanshu Jain, CFO and Head Corporate Center, and Mr. Saptarshi Bapri, Head Investor Relations from IDFC First Bank to discuss their Q2 and H1FY23 earnings. So at the onset, congratulations, good set of numbers, and wish the entire management team as well as the participants on the call a very happy Diwali. Over to you, sir.
To all of you tuning in today to talk to us, thank you very much. Wish you all a very, very happy Diwali to every one of you. Now, we have I got some 5 or 6 quick comments to keep it brief, and then Sudhanshu will take you through the details. And then we'll hopefully have more time for Q&A. Now, from our point of view, basically, we are seeing that the credit growth is quite strong. I'd say stable and strong because we are now at 25% loan growth. If you remember, for 3 years at a stretch, we held the discipline of not growing the loan book because we were not strong on the liability side. But now, with a 51% or 50% CASA, we are feeling very strong from the inside on the deposit side. So therefore, now we are in a position to start growing the loan book. The important thing is that we are growing the loan book along with growth of deposits. So, for example, last quarter we grew our loan book, YOY growth on deposit. The loan book was 25%, but we also grew the deposits by 37%. So now we know we are entirely funded through deposits, through incremental deposits on a strong basis, and therefore it provides us a solidity and also gives us the confidence that we will be able to sustain the CASA of 51% or 50%. That's very important because we need CASA for 2 reasons. One is we need CASA for normal growth, which we feel that about 20-25% of loan book growth should go on for a while. We need deposits for that. But in our peculiar case, we also need deposits to pay off that legacy bonds and borrowings, etc., which we need to pay. And that's about like 5,000-6,000 crores a year. So we need for that also. But the good news is that we are able to raise enough deposits to pay off both the past liabilities and also fund our growth. So that's coming comfortably. Now, the second part of the point is to notice that the credit quality. Now, on the credit quality front, I'm actually happy to tell you that all the input parameters, we call input parameters as underwriting quality is an input parameter. And underwriting quality, frankly, we were always good for 10 years now. Our gross NPA has been 2% and net NPA is 1%. So 10 years is a long time to establish a model. But the underwriting method, meaning the score, it's not just the output of 2 and 1. It is the score that is of credit score of customers and onboarding continues to be 84 or 85% of the customer base have credit score above 700. So that tells you that our customer profile is good and stable for a long time now. Now, this time we have also given some additional data in our presentations about underwriting method or LTV, our average ticket sizes, location, etc. A little more extra data is there. Now, the other input criteria that we see is how much are new to credit customers. That number is also trending downwards. We don't want it to trend too much downward because after all it's a specialty and we've grown that business for 10 years now. But it's still very much low, I would say. Then the thing that about the number of checks that return on presentation, that is really at an all-time low. What we track is the number of checks that return after presentation. In the first month after booking. So supposing you booked a loan in January, and the checks are due for presentation. First EMI is due for presentation in February. Then you just say in February how many checks are returning. And that number is really at an all-time low. And if it's low, means that the quality of incremental underwriting is very good. In fact, better than before. So these are input parameters. Frankly, all these input parameters, with no exception, are all showing that we're doing well. Which means that if you ask us to take a guess at the credit quality 1 year from now, 2 years from now, I would say it will only be better from today. So because of the reason I told you of input parameters. The third thing is about is also the SMA. The SMA is to the uninitiated. I could say that think of a loan book. A loan book would have some defaults. or delays, and 0 to 30 customers who are in 0 to 30 means 0 to 30 days outstanding. They're called SMA 0, and 31 to 60 is called SMA 1, and 61 to 90 is called SMA 2. So our SMA 1 and 2, which is the most, which you can call it 31 to 90 DPD. These are the in this bucket. Our SMA same year last time used to be 3%, which means that 3% of the portfolio could go to NPA. The amazing thing is that this SMA 1 and 2 has now come down to 1% in retail. Just think, 3% down to 1%. So which means that if there's not much portfolio left in that bucket only, we're not expecting much NPA formation going forward. So this also represents or talks to the quality that we are building. Now, so all in all, if you ask me, I'm feeling very comfortable or very happy with the quality we're building in the book. We can boldly guide to a low NPA and low SMA and all that in the future. Now, last thing is about this one. So this year, this quarter, we had if many of you recollect, we had a lot of security receipts that we had, which we had from the bank because these were infrastructure loans sold to ARCs prior to the merger. Now, the good news is that this quarter we sold some SR, and we got a happy outcome, I should say. Many of you would fear whether we'll take a hit and all that stuff. And happy outcome meaning we actually got we had taken a provision of 200 crores for those SRs. Now, 200 crores got released because they're actually sold well at a good price. So that 200 crores, suddenly you think of it like a bit of a unexpected money or a found money. Now, what do we do with that money? So we thought that we will use that to improve the provisioning coverage ratio of the bank. So we used it largely towards, so our retail PCR has now gone to 77.6% gross of technical write-off. The reason we take it a good benchmark is gross of technical write-off is that even the write-off customer base we are collecting from. So when you calculate provision coverage ratio as a percentage of gross of technical write-off, it will be appropriate because it's provisions divided by the gross NPA including write-off bucket because you are going to collect from them as well. So that number is now touched to 77.6%, which is an all-time high. And you can think that 200 crores has broadly been used up for that purpose. So it's not come through the P&L in a way, but at least it strengthened the balance sheet to that extent. On the wholesale side, of course, the PCR is now very, very good. We don't worry much about it anymore. It's like upward of 95% onwards, or 97%. The infra is the only one that we had a bit of an issue, but frankly, it's a rundown book. Today or tomorrow, it will go away. So the last thing is on profitability, I'd say, that we are very, very strong on profitability. A very simple way to understand our profitability is that last year our loan book has grown by 25%, but the growth in our operating profit, core operating profit, pure NII plus fees minus OPEX, core, that is up by some 84%. So if book grows 24, but operating profit grows 80, I'd say it's a little on the higher side. I would not expect that every quarter we'll get such kind of a high number, but certainly we feel that overall this year our operating profit should be upward of, at a year-to-year level, we should expect at least a 50% increase in operating profit over last year, but quarter-on-quarter it is even healthier than that, so you get the drift there. So that's on profitability. So basically, in all, I'd say that all our indicators are moving very well. We're very happy about how the numbers are going, and hopefully you'll also be more comfortable with us now, because for the first 2 or 3 years we gave you this bad news or that bad news. So, this wholesale or that or, early profitability, whatever. But now I feel that most of those clouds are behind us and we're feeling pretty okay, pretty good about the future. Now, in a sense, I'd say that, as I sign off, I'd say that we're building a really high quality bank. Our products are very customer friendly products, and anybody experiencing us is usually very happy. I personally just happen to, meet or bump into many customers whom we know are customers of the bank, and most people have really happy things to say about our service and all that. We are a very customer-oriented bank. Then our corporate governance levels are really very good. Balance sheet is very strong. ROE is catching up. So overall, I'd say that things are looking good. So that over to Sudhanshu if you have any specific numbers to share.
Thank you, Vaidya. Good evening, everyone. I will call out few key numbers for the quarter. I will start with the balance sheet size, which is now at rupees 2.1 lakh crore and has grown by 23% on a YOY basis. The growth was largely driven on the asset side by the retail portfolio. The overall funded assets grew by 25% and 6% sequentially to reach rupees 1,45,000 crores. In the retail class, the home loan segment grew by 59% on a YOY basis. Rural loans increased by 34% on a YOY basis, and consumer loans increased by 36%. These are certain asset classes which I've called out, but we have given a detailed breakup on slide 41 of the presentation. Moving on the wholesale side, the non-infra corporate book, that also grew by 20% YOY and by 4% on a Q-on-Q basis. The infrastructure book degrew further and is reduced by about 41% on a YOY basis and by 11% on a Q-on-Q basis and is now sub 6,000 crores. It now merely forms 4.1% of the total funded assets as compared to 22% at the time of merger. So there has been a significant downward move here. Moving to the liabilities front very quickly, the customer deposits has grown by 36% on a YOY basis. The CASA deposit growth was very healthy. It grew by 37% on a YOY basis to rupees 63,305 crores. The CASA ratio was again very strong at 51.28% as on September 30th. Average CASA deposits also grew by 13% on a Q-on-Q basis and 32% on a YOY basis. Even on the term deposit front, the growth was strong at 35%. So overall, the customer deposit growth came in very strong during the current quarter. The bank continues to maintain excess liquidity. Of course, we would want to calibrate some in due course, but for the quarter, it stood at about 131%. This is well above the regulatory requirement. The branch count now stands at 670 branches. The bank added 19 branches in the current quarter. The bank has also substantially granularized the liabilities, and which is reflected by CASA and TD, less than 5 crores, which is standing at 84% of the customer deposits. We have further repaid about 2,000 crores of high-cost legacy borrowings during the quarter. This residual borrowings now stands at rupees 20,444 crores, which is still at a high cost of 8.8%. We would sort of bring it down further. We have given statistics in the presentation in terms of what would be the rundown on this portfolio. Moving quickly to the asset quality, the gross and the net NPA of the bank was at 3.18% and 1.09% respectively, reflecting a sequential improvement of 18 bits and 21 bits. PCR, including technical write-off, has been enhanced to 76.5%. This was 70.3% at the start of the year. Further, if we strip out the rundown infra book, the PCR coverage is 83.3%, including technical write-off, and net NPA instead of the reported 1.09% would be down to 63 basis points. In the retail and commercial segment, the GNPA and NNPA came down sequentially by 8 bits and 20 bits respectively to reach 2.03% and 0.73%. The PCR on this book stood at a healthy 77.6%. We have increased PCR by about 545 basis points here during the quarter by further tightening the provisioning policy. On the corporate book, ex-infra, we continue to have a strong PCR coverage of 98%. Another data point to note, the restructured book as a percentage of total funded assets has reduced to 1% now as compared to 1.3% last quarter. The gross and net slippages for the quarter were at similar levels as the last quarter, despite the increase in the overall book. Vaidya mentioned about that the SMA on the retail has been coming down. It came down from 3% in September 21 to 1.8% in March 22, and now it was 1% at September. Even on the corporate book, the ratio of SMA 1 and 2 is sub 0.2%. Moving quickly to profitability, the profit after tax was highest ever for the quarter. It was 556 crores, up to 66% on a YOY basis and 17% on a Q-on-Q basis. I'm happy to share that on a quarterly annualized basis, the ROE did cross 1% and is now at 1.07%, and the ROE has reached double digit and was 10.12%. The strong growth numbers was largely driven by steady growth in operating income and lower credit cost as compared to the last quarter in the previous year. The net interest income grew strongly by 32% to rupees 3,002 crores. The net margin expanded by 9 bits on a Q-on-Q and 15 bits on a YOY basis to reach 5.98%. The increase was also due to a transmission which happened because of the repo rate increase on the existing floating rate portfolio. Fee and other income witnessed a strong increase by 44% to rupees 945 crores. Another point to note is that the retail fees contributed about 92% to the overall fee and other income, and hence it's quite granular. The bank had a trading gain of rupees 116 crores in Q2FY23 as compared to a trading gain of rupees 122 crores in Q2FY22 and a trading loss of rupees 44 crores in Q1FY23. Core operating income excluding trading gains increased by 35% YOY to rupees 3947 crores, aided by strong NI and fee income growth, which I mentioned before. Operating expenses grew by 23% on a YOY basis to rupees 2895 crores. The increase in OPEX was relatively higher on account of higher business volumes witnessed in Q2. The cost-to-income ratio improved to 73.34% in Q2FY23 from 80.53% in Q2FY22 last year. Core operating profit grew by 84% YOY and 7% on a Q-on-Q basis to rupees 1,052 crores. Provisions were also lower by 11% YOY at rupees 424 crores in Q2. The credit cost on a quarterly annualized basis as a percentage of average funded assets for Q2 was 1.2%, and for H1 it was at 1.1%, which is still much lower than the earlier guidance of 1.5%. We had some release of provisions on security receipts, which we used to beef up the overall PCR during the quarter. The last bit, on the capital adequacy, the bank has maintained strong capital adequacy, and the CAR was, including profits for H1, was 15.35%, with the CET ratio at 13.67%. Even at 15.35%, the bank is well over the regulatory threshold and looks forward to continue to growth in a profitable manner. With that, we can move to the Q&A.
That's 15 minutes or maybe 17, 18 between the two of us. So thankfully, this was a bit shorter. So over to you, people.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Bhavin Gala from Marine Capital. Please go ahead.
Thank you for the opportunity. Could you please confirm if I am audible?
Yes, sir, you're audible. Please proceed.
Yeah. Good evening and festive wishes to the entire team of IDFC First Bank. I have only one question to the MD and CEO. Could you please help us understand the performance in the recent quarter with respect to the retail banking operations? Because what we are seeing is this segment turned profitable a few quarters back, and there wasn't consistency as far as the PBT is concerned. But this quarter, what we could see is there was a drastic decline in the PBT from this segment. So if you could help us understand the reason behind this. Thank you.
No, thanks. I think it's a very, very important question. If you recollect my opening conversation, I told you we had suddenly we sold the SR, and then we got about 200 crores of provision release. So that provision release, we took it to retail, therefore it is showing up there on the retail line. For example, had we not got the 200 crores, we need not have really taken this provision of retail, to put it simply. So therefore, if you add back the 200 crores, then you know that your numbers are back to the trend line.
Okay, noted, sir. Thank you.
I mean, was it complicated or was it easy? Was it okay? I should explain again.
No. That's explained. Thank you.
Okay. Thanks.
Thank you. The next question is from the line of Ishan Agarwal from Revana Capital. Please go ahead.
Hi. Thank you for the opportunity. First of all, wish everyone on the call a very happy Diwali.
You can take the phone off speaker, please. Your audio is a bit muffled.
Yeah. Hello.
Yes.
Yeah. First of all, wish everyone a very happy Diwali on the call. So I have multiple questions here. First question being, in your last con call with us, you had advanced the guidance of a double-digit ROE, which was originally given for Q4 of FY23. However, if I look at the core numbers for this quarter, excluding treasury gains and do a like-to-like comparison with Q1, the PBT excluding trading income is lower in Q2 at 644 crores versus 678 crores in Q1. And hence, ROE and ROA excluding trading gains is lower in Q2. So, are you confident that the bank can touch core annualized ROE of 10% ex of treasury by Q3?
Yes.
Okay. And so secondly, so the annualized credit loss for this quarter was 1.2%. That is blended for retail and wholesale. What will be the annualized credit loss for this quarter for retail plus commercial book?
So we have not called that number out separately, but as I said, overall is 1.2%, and for H1 it's 1.1. We would not want to call out a separate number for a retail credit loss.
Actually, yeah, why I'm asking that is incrementally our book is concentrated on the
No. I think we can explain a little more. No, there's no issue. So basically, see the retail side. If you take the retail credit loss, it's about if you add back that 400 crores, the 200 crores, which I said is an extra provision. If you don't have that as a one-time item, so it'll be like about 400 crores.
Yeah. So
400 crores into 4 analysts is 1,600 crores.
Oh,
1,600 crores. You divide that by about a 1 lakh crore book, about 1.6%.
Okay. And this should get better as we concentrate more on home loans going ahead, or we expect it to be at 1.5, 1.6% and going ahead for FY24, 25 too?
We like to be conservative on this front and just say this number as we said it right now. And and if it gets better, just maybe we'll take it as a positive. But you factor in, if you're thinking of the bank, think of it that retail will have, after all, it's a pretty good yielding book. So, and our credit controls are working obviously very well, collections are working very well. Otherwise, for such a low credit loss of that we're talking about in retail, it's already pretty good. So I don't want to give any more aggressive guidances beyond this.
Okay. So, third question is, OPEX for this quarter is around 8.7% higher as compared to Q1, which is actually higher than the loan growth QOQ. So, is it because we have invested more on the technology front, or what is the reason for this large jump? Because this is also yielding to a cost to income plateauing from Q1 to Q2 at 72.9%.
No, really, quarter on quarter, it's very hard to explain this quarter, 20 crore up.
No, but in general, the jump has been higher at 8.7%.
No, therefore, let me finish. So therefore, I was saying that it's hard to really pin down a particular quarter for prior quarter. There are a lot of moving parts, a large bank. It's a lot of moving parts, but broadly speaking, you should expect the cost-income ratio of the bank to trend downwards from here. If you take a YOY, all these inter-quarter movements, a little bit up and down, gets evened out. So if you take a YOY basis, or a YOY meaning when you compare year of 23 versus year of 22 or year of 24, if you see it sequentially, things will keep coming down from here on.
Okay. So I have a few questions related to the bank and not the quarter. So the first one being, so when Capital First was founded, I would say that we were quite ahead of the curve in terms of developing an algorithmic lending model based on multiple parameters, demographics, marital status, gender, geographical location, to state a few, and hence we enjoyed a certain niche in that segment. Now that information related to a borrower is more easily available to a larger number of lenders thanks to aggregators, fintech startups like Cred, payment apps which capture cash flow data, and also a much larger penetration of credit bureaus, and also given the fact that now 90% of our borrowers have a credit history, has the significance of that lending model reduced for the bank?
Yeah, actually, it's a very good question. See, as you know, India is just not served. Simple. I mean, underserved would be a understatement. So, whether we play in this game or some 20 other players play in this game, this is a large story. And therefore, this benefit, this advantage we have is not going to go away. Because we'll still grow. After all, we are guiding for growth of only for 25%. So it's easy. Number two is that our ability to use the data, our own ability, forget what others do or don't. I'm sure others can also do a good job on these things. But our own ability to use this data is continuously getting better. So in a large underserved market, we should bother about how well we do and how well we can control our credit quality and so on. So our ability to use the data is only improving. Every year on year only improving. And for example, our algorithms are getting much more refined. Remember one thing, that our algorithm is a 10-year-old algorithm. That is, I mean, not 10-year-old algorithm. It's been continuously refined since 10 years.
It's maturing, yes.
Maturing, that's the right word, yeah. So it's like, it's getting, let me say, more and more precise. And the quality of that algorithm is getting better and better with every passing, let me say, year. Forget year, it's getting better every single quarter. It's getting better and better. So therefore, we feel we are very, very far ahead in this game because we have gone through a R&D ourselves. It's not something that we acquired here and there. It's like remember we built this company from grassroots of a 94 crore rupee loan book 10 years ago. So we know every single moving part of this machine. So I think we're getting better, and we'll be pretty good on this front.
So I would say that right now it's helping you on the credit quality front and not as much on the yield front, because we are also concentrating on better yield customers. No,
it's yes and no actually. Because if you notice, one very definite advantage we have as a bank, we may be new, we may not be as profitable as others, we may have other issues. But the one very unique thing about our bank is that our book itself has been created in an era of when our cost of funds was 9% or 10%, or at least the models are built for that kind of a cost of funds.
Right.
So therefore, we were specializing in lending at 14, 15, 16% and all that stuff, probably more. And at very good credit quality. You know the numbers, I don't repeat them. So therefore, now suddenly over the last 3 years, cost of funds have come down. So therefore, but our capabilities have not gone. Capabilities are still as strong. So therefore, we feel that this is a very distinct advantage. So if you see the mix of the book, our mix of the book would have would probably be better yielding. That doesn't mean we're taking more riskier loans. It just means that we're more specialized.
Right. Okay. So understood. Now, you've always been maintaining. Hello.
Sorry to interrupt, but may we request you to rejoin the queue, please?
Just last question, if I can chip in.
Okay, shoot. Let's try.
So, okay. So, you have been maintaining that, India is underserved and there's unlimited credit demand at least for the next 10, 20 years. Say just for FY24, because of XYZ reason, the GDP growth stagnates or is less than 3-4%. Even in that scenario, will you envisage that because of our small size, we will still be able to grow our loan book by 20-25%?
Yes, of course. See, it's very important. If you think of a very large bank with 20, 30 lakh crore loan book and all that stuff, of course they will be proxy to the economy. But we are not a proxy to the economy. We are very small yet.
Okay.
Coming from a very low base. To give you a small idea, supposing just to pick a number, supposing a loan against property or take any business, okay, we are booking say X number of X 100 crores a month. Let's call it, say 500 crores a month. If you want to increase it to say another number, say 600 or whatever it is, these are not the exact numbers, but I think we'll probably be close. Now, we don't have to do anything. We don't have to change the credit criteria. We don't have to, relax the criteria. We have to do nothing. We just have to open some 5 more locations, and lo and behold, everything will come. On the same location, you have to put up some more branches, you'll get it. So that's the benefit of being, that's the point I'm making when you're relatively early in the, let me say, when the book is smaller. We have a base effect, let me say.
Yeah. Thank you. Thank you so much.
We are nowhere close to the big players. Big players are at least 7, 8, 10 times our size. And
so if I have to put it that way, HDFC Bank is adding an IDFC First Bank every quarter. So,
could be, yes, absolutely.
Yeah. Okay. Thank you.
Thank you. The next question is from the line of Nitin Agarwal from Motilal Oswal. Please go ahead.
Yeah, hi, Vijay and team. Congratulations on a strong performance. 2 questions I have. First is we have reported some margin expansion this quarter, though the deposit costs are inching up. So if you can talk about how the incremental spreads are moving and how do you see the margins trending in coming quarters. Also, if you can share the proportion of loans that are linked to EBLR.
Sudhanshu, proportion of loans?
Yeah, I'll first start with the proportion of loans. Over 38% of the book of the funded assets are roughly linked to benchmarks, which could be MCLR or repo or T-bills. And out of that, about 60% is linked to repo and rest to other benchmarks. With respect to margin expansion, as we've guided earlier also, we feel that we will be comfortably able to maintain margins around a 6% mark. In fact, this quarter we are very close to that. We are 5.98%. We, of course, had the benefit of some reset with sort of benefit which kicked in during the quarter. As the loan came up for a reset, it comes once in every 3 months. And RBI has also very recently increased under 50 basis points. So that benefit should be slightly higher in Q3. So we feel that even though the cost of funds are sort of going up, even for us during the quarter, the cost of funds on a blended basis went up by about 25 basis points. But since this reset kicked in, even for the new loans, we have increased the pricing a bit. So a combination of this led to a higher sort of I would say yield on advances and interest earning assets, and which led to an increase of 9 basis points. So we feel that both these things would sort of work in tandem, and in fact we could be a beneficiary even going forward, right, as sort of the rate cycle plays out.
But give or take, like this 5.8, 5.9, 6, in that zone you should expect of us.
Right. Sure. And the other question from the consumer loan portfolio, while this portfolio has been growing like every quarter and the YOY growth now is 35, but this quarter the portfolio held essentially flat. So we have seen a stronger growth from other banks in the consumer loans. So any specific reason that has caused this?
Let's see the numbers once before we respond. You have the numbers. I don't do. Just 10 seconds. Oh yeah, the 600 crore book that we're talking about.
Yes, the Q-on-Q growth is almost flat this time.
Yeah, I think about 300 odd crores you must have sold this quarter.
Yeah, so we have sold about 333 crores of loans during the quarter, which were essentially out of this segment. Plus Q1 also was related also a strong quarter, right? Because of the summers, consumer durable sales were also equally strong and so on. So hence these numbers are the way it is.
But overall YOY they are quite strong.
Right. So basically, therefore, the retail book, this piece will remain one of the key growth drivers because LAP we have been going relatively slower, but consumer loan will continue to maintain this sort of traction.
No, not only consumer. All our lines will grow. I mean, frankly, we don't see. Look at home loan. Our home loan book is something like 15 or 16,000 crores. If you think of large banks, they're probably 4 or 5 lakh crore, maybe even 6 lakh crores. So can you even compare? So for us to grow 16,000 crore by 40, 45%, 50%, whatever, should not be no issue at all. Think of loan against property that can grow. Think of vehicle financing, etc. So see, one of the speakers earlier spoke about the base effect. So let me say we are a relatively small player, I'd say, when you compare the big 4 or 5 banks in the country. So we'll keep going.
Okay, sure. Got it. Thanks so much, Raja, and wish you all the best.
Thanks a lot.
Thank you. The next question is from the line of Lalit Deo from Equirus Securities. Please go ahead.
Good evening, sir. Thank you for the opportunity. Congratulations on a good set of numbers. So, sir, I had just 2 questions. So, firstly, on the borrowing side, so, sir, within the borrowings, our refinance portion has increased to about 35%, if we include the market borrowings. So, just wanted to understand, what is the broad range of interest which we are paying on these refinance borrowings? And also, could you tell us about the average tenor of these borrowings?
No, we don't do much borrowings anymore in the sense that I think you might be talking about market borrowings. These are treasury market borrowings. They are not the big item. But the Sudhanshu will say something?
Yeah, so I'll answer that. So we keep evaluating various funding options, right, in terms of term deposit, refinance, and other market borrowing. Right, we see essentially what is the prevailing rate, what is the average tenor of a funding which could sort of come in. So we have done some additional refinance borrowings during the quarter because one, they were of a longer tenor and the rates which were available were relatively better.
So this quarter very similar.
Yeah. If we had to compare with few other funding options which were available.
But the other, there is an item called other borrowings. See, if you go through the list, there's something called legacy long-term borrowings.
Yes.
Legacy long-term bonds. Then there's infra bonds. These 2 items are continuously coming down. So, of course, refinance, Sudhanshu just explained. Then there's an item called other borrowings. This could be, general routine stuff.
Sure, sir. And, sir, again, in the fee income part, so, we have been going strong in our credit card business. But on a quarterly basis, the fees from the credit card and the toll business has declined on a quarterly basis. So now with the festive season, and we believe that there was the spends would have been strong. So what could be the reasons for the decline in the credit card fees during the quarter?
No, so that essentially is a decline which has happened on the toll business. So there has been some changes which has been done in the MDR, right, especially on the issuing side. And this is a notification which sort of came in this quarter and was effective April 1 of 22, and hence that sort of readjustment happened through that line item. And on the credit card, the fee has gone up on a sequential basis. So this was essentially largely because of the toll business.
But broadly, I should say all our fee businesses are doing very, very, very well. Whether it's cash management or toll or wealth or credit cards, every product is turning out to be a big success in the market. So nothing to worry.
Sure, sir. And sir, in the home loans portfolio, so we have given some extra details on this portfolio. So just wanted to know if you can share the portion of the salaried customers in the home loan portfolio and how has it changed over the last couple of years?
I don't have a number offhand, but I'd probably, if I were to ask to take a guess, it'd probably be about 55-60% would probably be salaried. But maybe next time we'll be better prepared on this question.
Sure, sir. Thank you, sir. And happy Diwali to everyone.
Thank you. Wish you a happy Diwali as well.
Thank you. The next question is from the line of Ashutosh Kumar Mishra from Ashika Stock Broking. Please go ahead.
Congratulations for a very good set of numbers. My question is basically on the cost to income. So we are guiding a cost to income ratio of 65% by the end of FY25. So can you guide us on what are the levers on this front which will help us to take it from the current plus 70% to 5%?
Okay. See, this cost to income, I'll give you some very specifics. It'll make it easy for you. Our cost to income for this quarter will probably be like 74%, 73 point something. Now, we have always said many times earlier, but we'll repeat it for context. We said there are 3 lines of businesses which are going to improve our cost to income going forward. And they are very precise, defined items. They will play out. Number 1 is paying off these legacy liabilities. We'll contract them at 8.8, 8.9. We'll replace them at 5.5. There's a lot of money to be made there. That will give us about 150 on a quarterly basis. If you do the differential of 8.8 minus 5.5 and you multiply that by this 23,000 crores, you'll get a number of 150 crore. So you think of it, it will come to us, nothing to be done. Number 2 is that credit card business we told you about 75 crore. Earlier we used to say 75. Now our credit card loss a little less than that because scale is coming up. Let's call it a 75 crore number, round off. Number 3 on the retail liability side, because the branch has ATMs, all that stuff, we told you 300 crores a quarter. Now, so I'm rushing through it because I've said these numbers before, so I'm trying to save time.
Sure.
So in this quarter's P&L, you add these 3 items, 150 plus 75 plus 300, and then that number works out to something like 525 crores. If you take the PAT impact of that number is, if you take 75% of that amount of 525 crores, it will come to 390 crores. Now, sorry, let me not go there. Let me just add these 3 numbers, comes to 525 crore. Now, you divide our expenses of this 2895 crore by 4472 crore. That is, this reported number, that is 3,950 crores of income, and then you add this number, what I said, will come to us by simply playing out the next 3 years. So then that number, you divide 2895 crore and divide by 4472 crore, you'll come to 65%. So in my mind, this is a pretty simple, straightforward proof that we will easily head towards a 65% cost-income ratio simply by paying off the liabilities and making credit card profitable and, making the liability profitable.
Okay.
So we feel that it will happen. I mean, in our mind, there's no doubt at all. So I hope these numbers, and I told you, they will. If you do the math, I spoke a bit too fast, but if you go back off record and you do the math, you'll get the same numbers.
So do you think, because of the rise in the cost of funds, which is expected in the next few months out there, some of these numbers need to be revisited?
We couldn't hear you well.
Mr. Mishra, your audio is...
Yeah. It's now okay? Yeah. So, because we have one of the important assumptions which we are taking is the benefit which we are going to get on the paying off the legacy liability. Because of what is happening on the cost of fund front, especially the last 1 or 2 weeks, we have seen larger banks are increasing the term deposit rate in a very aggressive way. Do you see some of these things getting a little bit more instead of FY25, it will go to FY26 like that?
No. When we did that number, when I did the maths for you right now, that I added 150 crores for the legacy, that already factors for the new slightly higher interest rates.
Okay. Second point.
Sorry, before you go there. So I want to just, for other people who probably did not catch on to the conversation, I'd like to explain a little bit more. You see, if you think of large banks, none of them is carrying a borrowing at 8.9%.
Yes.
Yes or no? So
yes.
when we are borrowing at 8.9, not that we're borrowing, we have borrowed, let me say, it's a legacy item sitting on the balance sheet. So therefore, you cannot really compare our cost of, our cost income with other banks because we are early stage. You give me 15 years, I'll show you what our cost income will be. You'll rub your eyes. So therefore, you cannot compare a 3-year-old bank cost income with a 25-year-old cost income, bank with cost income.
Totally, I agree with you on this.
Yeah, and particularly, let me tell you something very important for you to note. You go back and see the numbers; it's there on they're public. The cost to income of our bank pre-merger was 92%. 92. The numbers are there on the website. So when 92 has come down to 74 point something, boy, it is a major progress. So it just tells you that incrementally you're building the bank at a very good cost income, and as and when the story plays out, it will come down. So this is to be very much remembered. So don't worry about the cost income. I mean, I'm not so stressed about it at all. I know I just have to play a normal game and it will come down.
Okay. On basically in the deposit, the liability franchise which we have built over the last 3 years, so how much of them has now been break-even, or if you can give some light on that, that will further give more clarity on this path, especially on the new branches, how much we are opened and what is the
See, there is no real benchmark about how to compute this. For example, in the sense that do you compute this including allocated costs from the head office, or is it a pure variable basis, and everything will give you different results. But broadly, I'd say that our close to about maybe 450 odd branches, or maybe 400 branches on a variable basis would be profitable.
And roughly, what is out of our total OPEX, how much is technology expenses in our rough estimate?
No, we haven't specifically gone there.
Okay. Thank you.
Okay, thanks.
Thank you. The next question is from the line of Sahil Sharma from SS Capital. Please go ahead.
Hi, sir. Congratulations on a very good set of numbers. First question I have is, we are building a bank for the next many decades, and I'm sure we are also, hiring with that in mind. Can you please talk a little bit about the kind of, credit risk team that we have on the retail side? Because I think in the banking, the most important thing is to get the money back, right? It's not just about giving it out.
Absolutely. I agree with you 100%. So in terms of people we are hiring, it's not so much the credit managers anymore. That's a bit of 5 years ago. But as you know, every 5 years, India is changing so fast. Earlier in credit, we used to hire credit managers who would really look at a file in great detail and evaluate it and all that stuff. Of course, we still need to do that in products like loan against property or a home loan, etc. You still need credit managers who have to physically look at some of the files. But incrementally, a lot of people or machines are doing all this work. So our focus, of course, is on developing really good high-quality algorithms by using AI, ML, etc. And the skill levels of people we're looking to hire is of really higher order, not the traditional people who will smell files and all that.
I see. Thank you, sir.
So we're building that kind of people. The other kind of people we are trying to build is the people who can build some really, since you said quality kind of people, you of course need high quality technology people, good high quality engineers. As a bank, we provide really, really good working environment, and our employees are very proud about the bank we're building because they can see from within the quality of the bank we're building and the ethics and all that. So we're able to hire really high quality people. Any position we look out for, like the hundreds of applications pour in. There is literally we're spoiled for choice because that comes through. We're looking at hiring design people, for example. As we speak, if any of you are hearing the program, and if you are probably a very, very good high quality, high end design person, please let us know. I'll be very happy to hire you right now. We're looking for a head of design who can cut across to build really good user interfaces and UX. So we're looking for that kind of profile of people, high quality technology coders, DevOps people and all that.
Yeah, thank you so much, sir. And the second question I wanted to ask about, just tying back to the other speaker's question, I think what we as investors really appreciate, I've been with the bank for like 3 years now roughly, is that we have really turned around a DFI institution plus NBFC into a retail bank. And that has been a fairly long and strenuous journey. And on most fronts, we have made tremendous progress. I think the last remaining thing now, which is at the top of the mind for most investors, according to me, is cost to income, which is why most of the questions are also around that. And so I think your answer is brilliant on the income side especially, which is that, how the income will expand. But I think one of the things which I think we would really appreciate as investors is if you can also share on the cost side, if there are is this the correct leverage for the cost, or, for example, if we double our AUM, we probably shouldn't expect to double the operating expenses, right? For example, probably the branches won't double from here. The lease costs won't double from here. And, things like that. So, I think one thing that would really help is if you can give some rough guidance for the cost to income, for FY23, FY24, based on your best understanding.
Okay. Now, first of all, thanks for that. Yes, we are. When we're thinking of the bank, we're really thinking long. We're not doing any shortcut. You may have noticed for 3 years have gone by, we've not done one item that's a shortcut. Okay? So we'll not do shortcut things. Now, the second thing is about when you said you're happy about the stuff, thanks for that. But I'll tell you, we are not just building a DFI converting to a retail. That, frankly, anybody could do. But the thing is that it's hard, but people could do it. But what we are very proud is about the culture we're building in the bank. It's very clean, very ethical. People are trained to be ethical. People come from any organization. We tell them this is where we do work here. Not that other people are bad. They're all good quality ethical people. But I think we are building this in the DNA. All that is, that talks from within. So that's what it is. Now, coming back to your cost income comment, one is, of course, I specifically reconciled for you to earlier one of the speakers who talked about where we added up that 3 items of legacy, etc. You add that, you will find that cost income is straight away come down. I'm telling you, within three years, you will see that you will get there. If you just watch the story play out year after year after year, it will go there. I'm not disturbed because I can see it I'm an insider, of course. I can see it. You will also see it. So as the scale plays out, automatically cost income will sort out. That's how it plays. Initially there is cost. After that there is income. So that's how it plays. So now with regard to there is one data point which none of you, I'm going to share some data points with you, and this will help you understand the bank, how the bank has progressed. Okay. Now, if you take the core PPOP of the bank, core PPOP, without any other income lines, a core PPOP of the bank in FY19 was 1,100 crores. Okay, 1,100 crores. Half year. Annualized for the half year. That is Capital First and IDFC Bank both put together, for December 18 quarter and March 19 quarter. That is the first half year after the merger. That was 1,100 crores. Now, if you take even if you assume credit cost at maybe about 1.4% on the whole book, retail being 1.5, 1.6 and wholesale being a little less than that, blend. If you take 1.4, which is a very reasonable assumption, that would come to 1,300 crores on the book. So actually on the core, the bank was a loss machine even after merger for the first half. Pre-merger, so I can tell you that it was basically the income was 743 crore and assumed credit cost was 988, so it was actually a loss situation. So that's not the point. The point is that this was 199 crore negative. Now FY20, when you do the same analysis, core PPOP minus core credit loss, it is coming 250 crore positive. FY21 has gone to 400 crores. FY22 has become 1,079 crores. And FY23, you can multiply this quarter's numbers or whatever it is, and you have analysts have put out some numbers about operating profits, so it's not difficult for you to guess. So, we already guided about 50% over last year. That means about 4,200 odd crores of PPOP. So the point I'm trying to say is that if something is rising from minus 200 to plus 250 in 2020 to 400 crores in FY21 to 1,000 crores in 2022 to whatever number this year will be, which is a substantial increment, you can see how this chart is rising. So we as insiders can tell you that the core is delivering very strong. So all items will fall in place as they play out.
Thank you so much, sir.
You watch out 23, you watch out 24, you watch out 25. I don't think this trend is changing.
Yes. Thank you so much, sir. My last question is on capital adequacy. I think we're at around 15%. Are you comfortable with this, and would there be any need for fundraise in the next 1 or 2 years to support the kind of 20-25% loan book growth that we want?
Well, we'll evaluate this from time to time because, internal accrual is also going to be strong now. Growth is also strong. So we'll play out this equation.
Okay. Thank you, sir. Thank you.
Thank you. The next question is from the line of Sagar Shah from Phillip Capital. Please go ahead.
Good evening, sir. First of all, congratulations for excellent set of numbers, as to say. Now, I have just 2 questions actually. So, first of all, we have already reached about 10% ROE in this quarter itself actually, instead of the fourth quarter that you were guiding for. So, we are early in the game actually. So going ahead, what are the key drivers for further traction in the ROE? If we are expecting anything traction in ROE for around 13 to 15%. So what are the drivers, first of all, for the traction in the ROE and the ROA? And the second question is, going ahead, since we are having almost a very good run as far as the economy is concerned. So going ahead, do you see even on your corporate front, your corporate growth even for credit will go up as compared to retail? And my last question was, have we seen the average cost of the deposits and borrowings that is coming at around for 6% if we compare for this quarter? So are we peaking out on the average cost of deposits and borrowings actually, at least for this quarter and for going ahead?
Yeah, I'll start with the last one. So on the average cost, as I said, average cost for us for Q2 was about 5.5%, which was about 25 bits higher than the previous quarter. Of course, and many of the repo increases, I think, are factored in the market rate, and that's how it's playing out. So we don't see a substantial increase going forward. Offset to this, as I said, even the loans get repriced in the equation, and hence we see that both should move in tandem. So we are not very worried on that front.
Sorry, one thing to add to that. So from our point of view, we don't take any fixed positions on interest rates in the market. So we are right now, frankly, we're paying only 4% up to 10 lakhs. And we don't intend to touch that, honestly. But I've always said that we have enough margin, and if required, we'll always touch something or the other. But we won't let our deposits machinery slow down. We don't see the need as of now, but we'll watch.
Okay, sure, sir. Now, for my first question, so what are the key drivers for your ROE going ahead, sir?
Scale, that's all.
Okay, so scale. But is this anything related to maybe your OPEX growth normalizing and your income growth increasing? Can we relate to that extent?
That's what scale means, right? Because if supposing the expenses increase by maybe 20 to 22%, but income grows by 30 odd percent, that's straight away. And remember, income is, we expect it to grow by 30% on a larger base, and the expenses will grow by 22% on a smaller base, obviously even today. So you know how scale plays out. That's exactly scale and operating leverage. And of course, there are so many other product lines like fees and all that stuff. So many new lines of business will launch, all that will grow.
Okay. So because in this quarter...
So sorry to interrupt, but for any follow-up, may we request you to rejoin the queue, please. The next question is from the line of Franklin Moraes from Equentis Wealth Advisory.
It's 7:30. I'd love to wish all of you happy Diwali and wish close the meeting. So if you have any last few questions, to push it in, why don't you do that?
Just one last question, sir, before.
Yeah.
The next question is from the line of Franklin Moraes from Equentis Wealth Advisory. Please go ahead.
Sir, thanks for taking my question. So I just wanted to understand, from the time of opening a branch to the time the entire costs are loaded, what is that period? How many months does it take?
No, I told you earlier, it's hard to, everybody puts different numbers on these things. If you take it on the basis of pure variable cost, you'll get one answer. If you take a fully loaded cost, you'll get another answer. So depending on which way you look at it, it could even be 18 months, it could be 24 months, it could be somewhere in that zone, depending on how you load the cost and look at that. But we shouldn't looking at it like that. The way we look at it is that end of the day, cost, we don't want to give explanations to people that this is because of this reason or because of put more branches or credit cards or legacy liabilities, etc. These are really details which, people like yourself or anybody's willing to bend a little extra back. my apologies. Anybody who's willing to do some extra work, they understand these things. But for most people, end of the day, people will just look at your ROE and say, end of the day, are you improving? So whatever it is, all costs put together, we are committed that our ROE will go up. So it will go up year on year from here on. We have no doubts in our mind. It's already going up. You can see last 4 quarters. We feel that this will go on. I must say one last thing because it's very important. In the context of some of the questions that I asked earlier. Now you take this quarter's PAT of the bank, okay? Now, I told you that there are 3 items which are those well-known items. So credit cards, legacy liabilities, and the setup cost of a branch, right, of the bank. So you take these 3 items. We told you it's 525 crores, or let's call it 500 crores. Now you take the post-tax impact of the number. That'll probably be about 375 crores or 380 crores. Now, in other words, if this had just been a mature bank, give it 3 years, or maybe 4 years, and then you find that this amount of money will start coming to the P&L hopefully. Now, this quarter's PAT was 555 crores. So you add 555 crore and add that number of 375, you'll go to 946. You add 946 into 4, that's 3,800 crores. So what's the equity base today? 22,000 crores. So what is 3,800 crores of 22? You're nudging 16, 17. So do you have any doubt in your mind that these 3 items, we can't turn these things around, those 3 items? Of course we will. So in my mind, even if you do a simple plain math of just add these numbers and then, do it, bank is heading to a very healthy ROE. So for those of you who are willing to wait, give us the time, you will see the numbers and we have no doubt.
Yeah, thanks a lot, sir, for the elaborate response and wish you a very happy Diwali.
Yeah, thanks very much. Thanks. I wish you all a very, very happy Diwali. From our side, let me tell you that we are feeling quite comfortable.
Yeah, thanks, Mr. Vaidyanathan and the entire senior management team of IDFC Bank for answering all the questions.